Types of business ownership. Hi, my name is Bill Carmody, and I'm going to talk to you about one of the most important decisions you'll ever make as a business owner. Most people think it looks like this: a collaborative collection of people working together in order to create this amazing business. And so that's when it's done properly, that's exactly how it can be. But oftentimes, if you don't think about your business structure ahead of time, it's a lot more like this. You're locked into legal agreements and gargantuan legal headaches because you didn't set up the right structure, especially when there are business partners involved with the business. Popular business types of ownership include, number one, a sole proprietorship, a business owned and operated by a single person with no legal distinction between the owner and the business. In other words, it's you. Whatever you do is the business, and whatever the business does is you. Now, that might sound very attractive, but it's not necessarily the best business to protect you both legally and from a tax perspective. So let's keep looking. You have a partnership. It's a business owned by two or more people where each partner shares in the profits and the losses of the business. Now, this can be very lucrative in the sense that you're actually sharing in the wealth. You're also sharing in the expenses. That's a great way to consider what that kind of a partnership might look like from a legal and from a financial perspective, especially when it comes to tax implications. But let's keep looking. You also have a limited partnership. This is a partnership in which one or more partners are limited partners who have limited liability and do not participate in the day-to-day management of the business. So if, let's say, for example, that someone wants to invest financially into the business, they could become a limited partner so that basically you're still making the calls day in and day out, and they have limited liability because they only put the money in. So what they're risking is the financial abundance that they've created for you, but they're not on the hook for all the other decisions that you make. So God forbid you have a lawsuit, they're not going to be impacted by that lawsuit. They're only on the hook for the money that they invested originally. A corporation. It's a separate legal entity owned by shareholders where the shareholders' liability is limited to their investment in the company. So what's interesting about corporations, most people think about corporations as like Fortune 100 companies. That's called a C Corp. But that's not the only type of corporation there is. There's also the S Corp. This is a type of corporation that meets specific IRS requirements and is taxed like a partnership with income flowing through the shareholders. So what's really cool about the S Corp is you don't have double taxation. In a C Corp, the business gets taxed and then you also get taxed. With an S Corp, the actual tax consequences of the business flow through its partners. So if you're 100% of an owner, that means all of the liability and taxes associated with the business flow directly to you, but you're only paying it once. You're not paying it twice. And let's say you have a 10% owner in an S Corp, well, then you would pay 90% of the taxes and they would pay 10%. So you can structure it this way to create protection for yourself, but also to have an opportunity to work with an accountant to say what's going to be best from a financial perspective, mitigating your tax consequence. And then you have a limited liability company, or LLC, and this is a hybrid legal structure that combines elements of a corporation and a partnership, with owners enjoying limited liability protection and flexible tax options. And specifically, if there are things like real estate transactions, LLCs are really the way to go. And then there's also a cooperative, a business owned and operated by its members who share in the profits and losses of the business. Now, the question you might be asking is, well, which one is right for me? The type of business ownership chosen will depend on various factors, including the number of owners, the liability protection, the tax implications, and the management structure. This is what you want to really hammer down. Who's doing what? How many people are you having that are going to have ownership in the organization? Think about that. Who are the principals of the organization? What are the tax implications of each principal? And what are the liabilities that you each want to hold on to? This is not something you want to figure out on your own. You definitely want to consult with a lawyer or an accountant. And I'm going to just tell you from my own personal experience, the decisions you're making right now about how to form your organization are going to impact you 5, 10, 15 years into the future. So it's really important that you think about structure ahead of time. This is definitely one of those times when you want to measure twice and cut once. And you say, oh, but I can't afford a really good consultant or a tax advisor or a lawyer. You know what? It's nonsense. Because ultimately, the money you're spending right now is going to far exceed the legal battles you get into with business partners or the tax liabilities that come in because it wasn't set up properly. Definitely take the time to invest. There are many legal resources and tax resources out there that are very economical. So do your homework, find a good accountant or lawyer that works for you, so that way you can make the best decision now and in the future.